everyone. I'm Andrea Wells with Insurance Journal. Today, we are delighted to bring you a special broadcast delving into the world of reinsurance with a focus on the 1/1 Treaty Renewals. And now I'll be joined by our international editor and journalist, L.S. Howard, who has more than 30 years of experience covering the reinsurance industry. Lisa, let's dive right in. Last year's January property catastrophe renewals were viewed as one of the worst on record. In September, the headline of one of your stories declared, "What a difference a year makes." That was also the title of the Gallagher Re report describing the January 2024 renewals. Lisa, could you explain how different this year has been compared to last year's renewal?
Last year's January renewals were described as the hardest market in a generation. I first noticed the warning signs when I was attending the 2022 Reinsurance Rendezvous. The last interview I had at that meeting was with a senior leader at a major broker who spoke off the record, unfortunately. He was pretty annoyed about the reinsurers who were indicating they were backing away en masse from property catastrophe reinsurance. This broker said a lot of reinsurers were insisting that they wanted to move away from volatility. But he angrily said, that's what reinsurance is. That's what reinsurance has always been. And if you move away from volatility, you'll start to make yourself redundant. That's the industry's raison d'etre. Brokers commented at the time that the reinsurers' decisions to exit property cat came without much communication with their ceding company clients, which had strained long-term relationships. However, during the 2023 Reinsurance Rendezvous de Septembre, brokers reported that reinsurers had rediscovered the needs and interests of their clients, again putting clients at the center of conversations. And that change of attitude continued into the January 2024 renewals. As Gallagher Re said in its renewal report, faced with a decade of deteriorating results, coupled with climate change pressure, the reinsurance market needed to self-correct, and it did.
That's really interesting, Lisa. Maybe you can get in a bit more. In just a year, the market seems to have shifted from relief of reinsurance buyers, brokers, and of course, reinsurance underwriters. Now we're seeing a different market. Like, how would you characterize these structural changes that you spoke about in the property cat reinsurance market from 2023 to 2024? What changes has the industry seen?
Capacity has returned. Reinsurers seem determined to maintain underwriting discipline. We'll see how long that remains once competition returns to the market. During this year's January renewals, brokers with loss-affected programs saw further upward pressure on retentions and prices, continuing a trend that began in the January 2023 renewals. Reinsurers raised their attachment points so they wouldn't get hit with the smaller but more frequent claims generated by so-called secondary perils, such as severe convective storms. Until 2023, reinsurers hadn't changed the retentions of ceding companies much, but they have now, and they are seeing improved profits. I guess a good example of the cost of these claims is that during 2023, the industry saw $123 billion of catastrophe losses, most of which was driven by severe convective storms. According to Gallagher Re also said the SCS peril accounted for an estimated 58% of global insured losses, or a record-setting $71 billion. The U.S. alone accounted for $60 billion of the Nat Cat total. So you can see why reinsurers wanted primary carriers to retain more of the share of the risk. And given the fact that many reinsurers are likely to see strong profits from last year and into this year, it has reinforced their determination to keep retentions higher.
After last year's January renewals, I know there was some deep frustration expressed by brokers at how some reinsurers dealt with their buyers during the renewals. Could you elaborate on that a bit? What went wrong during that period, do you think, or did you hear? And more importantly, how have things changed or evolved?
Sure. The January 2023 renewals were probably a good example of what not to do in any reinsurance negotiation. In last year's broker comments about the renewals, they openly expressed their disappointment about how reinsurers handled negotiations. For example, they couldn't reach reinsurers early in the renewal process. As Gallagher Re said, only a limited number of reinsurers were prepared to offer quotes in a timely fashion, leading to difficulties for clients and their brokers to find market clearing prices, terms, and conditions. Let's just say it's strained some long-term reinsurer and ceding company relationships, and it's unusual for brokers to publicly discuss such delicate matters. However, that's clearly changed this year. In the weeks leading up to the January 1st renewals, reinsurers' plans were better telegraphed, which lessened tensions and dislocations from a year ago. In addition, renewals proceeded in a timely manner, with most reinsurers taking a more open approach. This is a quote from Aon. Following a challenging 2023, global insurers have renewed their focus on trading relationships, reinforcing the value placed on consistent reinsurer communication and the breadth of trading relationships. What a difference a year makes.
So relationships are really important this year, mending what happened from last year.
Well, they're always important.
Absolutely. I think the industry will agree with that. Well, even with the restored balance between supply and demand in the reinsurance market, and notably a resurgence in reinsurer profits, hurdles still persist for both reinsurers and reinsurance buyers. Can you elaborate on some of the continued challenges that we're seeing in the reinsurance market today?
Sure. A lot of the ongoing challenges for the industry are related to climate change and the costs that it will shoulder in the future, now and in the future. For example, with the growing frequency of non-peak secondary perils, which include these nasty, severe convective storms. This has caused reinsurers to raise their attachment points, and primary carriers are taking the hit. As Aon pointed out, U.S. regional carriers bore the brunt of record severe convective storm losses throughout meaningful portions of their portfolio in 2023. While increases in retentions a year ago have mitigated reinsurer losses and contributed to their positive returns in 2023, this has come at the expense of increased retained losses for insurers. And of course, many insurers struggle to get higher primary pricing from regulators. There are solutions available from their reinsurance partners, according to brokers. For example, a growing number of buyers are looking to utilize structured buy-downs to reduce balance sheet volatility. One broker told me that primary carriers need to not only raise rates, but they also need to improve their original underwriting. Clients that can demonstrate the steps they have taken to improve profits should be rewarded by better reinsurance prices and more favorable terms going forward.
Seems to make sense. Well, let's jump into casualty treaty policies, which presented a varied landscape as outlined in one of your recent articles. What factors contributed to this mix, Lisa? And could you shed light on the prevailing casualty trends observed during the most recent January 1, 2024 renewal cycle?
It's interesting. Last year, when the reinsurers turned their backs on property catastrophe, some looked to expand in casualty. But this year, casualty faced more scrutiny, and as one broker said, casualty was no longer the valuable currency that was used to support property catastrophe capacity this time last year. Overall, the picture was mixed, with reinsurers showing varied appetites for casualty. Some reinsurers adopted a tougher stance because they were concerned about prior year reserve deterioration and adverse litigation trends, especially in the US, of course. At the same time, other reinsurers recognized the earnings potential of improving primary casualty pricing, along with the benefits of higher interest rates. As Gallagher Re says, casualty renewals were affected by loss experience, underlying rate changes, and prior year development across individual portfolios. Underwriters overall were more discerning. All the brokers are saying that underlying prior year loss development and social inflation trends have affected U.S. markets more than international carriers. There was a lot of concern last year, expressed by Lloyd's and other carriers, that prices in the directors and officers line of business had become moronic. I love that quote. During this year's renewals, brokers confirmed that D&O continued to drop, but reinsurers are becoming more cautious and risk selective. Gallagher Re acknowledged that underlying rates in the U.S. for public D&O had decreased, but there are indications that decreases are moderating. That's good news because excessive competition leads to excessive losses.
A little bit of good news there, I guess. Well, and finally, I think viewers may be interested in this year as we look forward in 2024. What insights or predictions are market practitioners anticipating for the year ahead?
Reinsurers seem determined to cover their cost of capital by maintaining profits and underwriting discipline. However, in my long experience covering this industry, underwriting result is rarely maintained. Let's see what happens when underwriters across the market try to find ways to deploy their capacity and achieve targets. The good news for reinsurers, at least, is that reinsurance demand is strong because many insurers, which retained a lot of losses due to those higher attachments, have seen capital erosion and volatile underwriting results. This has resulted in increased rating agency scrutiny for many insurers in many markets, which will drive some increased demand for reinsurance during 2024. It'll be interesting to revisit this conversation over the coming year.
Absolutely. Thank you very much, Lisa, and for your insights today. And we definitely want to aim to revisit the topic in the coming months during the next renewal cycle. So thank you so much.
My pleasure, Andrea. Thank you for having me on today.
And to those of you watching, make sure to explore all the articles mentioned today and more on insurancejournal.com, where you can stay up to date with all your breaking property and casualty insurance news. And don't forget, you can also download our latest magazine issue for free at insurancejournal.com/magazines. Happy reading.